Real estate financing is one of the most powerful financial tools available today. It's how most people buy homes, how investors build portfolios, and how wealth is created or lost on a massive scale. In this video, we'll break down exactly how real estate financing works, why it matters, and the long-term financial impact it can have on your life. Let's begin by understanding what real estate financing actually is. At its core, real estate financing refers to the methods and tools used to pay for property. This usually involves borrowing money, most commonly in the form of a mortgage, to fund the purchase of a home or investment property. The borrower then repays this loan over time, typically with interest. The most common type of real estate financing is the mortgage. A mortgage is a secured loan, meaning the property itself is used as collateral. If the borrower stops making payments, the lender has the legal right to take the property through a process called foreclosure. There are several types of mortgage loans, and understanding them is essential. First, the fixed-rate mortgage. This loan has an interest rate that remains the same for the entire life of the loan, often 15 or 30 years. The advantage is predictability. Monthly payments stay the same, making it easier to plan and budget. Then, there's the adjustable rate mortgage or ARM. This starts off with a lower interest rate compared to fixed-rate loans, but the rate can change over time based on market conditions. While you might pay less initially, there's a risk your payments could rise significantly later. Now let's talk about government-backed loans. These include FHA, VA, and USDA loans. FHA loans are insured by the Federal Housing Administration and are designed for buyers who may have lower credit scores or limited savings. These loans allow down payments as low as 3.5%. VA loans are available to military service members, veterans, and their families. They typically require no down payment and have competitive interest rates. USDA loans are aimed at buyers in rural and some suburban areas. Like VA loans, they may require no down payment, but eligibility depends on income limits and property location. Another major type is the jumbo loan. Jumbo loans are used for properties that exceed the lending limits set by Fannie Mae and Freddie Mac. These loans often require higher credit scores, larger down payments, and more rigorous financial documentation. Now let's focus on the down payment. This is the amount of money a buyer pays up front when purchasing a property. Traditionally, a 20% down payment was considered standard, but many lenders now accept down payments as low as 3 to 5%, especially with government-backed loans. However, putting down less than 20% often triggers private mortgage insurance, or PMI. PMI protects the lender in case the borrower defaults. This insurance adds to your monthly payment, and while it can be removed later, it represents an additional cost during the early years of the loan. The size of your down payment also affects your loan-to-value ratio, which is one of the key factors lenders consider when determining your risk profile and interest rate. Now let's look at interest rates, which can have a huge impact on your total cost of borrowing. Even a 1% difference in interest rate can translate into tens of thousands of dollars over the life of a 30-year mortgage. For example, on a $300,000 loan, a 6% rate versus a 5% rate could cost you over $50,000 more in interest over 30 years. Your interest rate depends on several factors. These include your credit score, income, employment history, debt-to-income ratio, loan amount, and of course, the overall economy and Federal Reserve policy. When interest rates are low, borrowing is more affordable, which can stimulate home buying and boost property prices. But when rates rise, monthly payments increase, and some buyers may be priced out of the market. Next, let's talk about closing costs. These are the fees and charges you pay to finalize a real estate transaction. Closing costs typically range from 2 to 5% of the property's price and can include appraisal fees, title insurance, inspection fees, attorney fees, taxes, and lender origination fees. It's essential to factor in these costs because they represent real money that comes out of your pocket, often up front. Some lenders offer no closing cost loans, but those usually come with higher interest rates or rolled-in fees, so you end up paying more over time. Now, let's explore the financial impact of real estate financing from a homeowner's perspective. Owning a home through financing can be a smart long-term financial decision. As you pay down your loan, you build equity, meaning the portion of the home you truly own increases. Equity can be a powerful source of wealth and even be borrowed against in the future through tools like home equity loans or lines of credit. Additionally, mortgage interest is often tax-deductible, providing another financial benefit for homeowners. And historically, real estate has appreciated over time, allowing homeowners to build net worth simply by staying in their homes. However, real estate financing also comes with risks. If property values fall, you could end up owing more than your home is worth. This situation, known as being underwater on your mortgage, was a widespread issue during the 2008 housing crisis. Missing payments or defaulting on your mortgage can damage your credit score and lead to foreclosure. This is why it's crucial to avoid borrowing more than you can realistically repay, and to budget carefully for your monthly housing costs. Let's now turn to the investor's point of view. For real estate investors, financing provides leverage. By borrowing money to buy properties, they can use a smaller amount of their own capital to control more assets. This amplifies potential returns, but also increases risk. A successful real estate investor must analyze cash flow carefully. That means factoring in not only the mortgage payment, but also property taxes, insurance, maintenance, vacancy rates, and management fees. If a property generates more income than it costs to hold, that's positive cash flow, an essential ingredient for long-term success. Some investors also use creative financing options like seller financing, private money loans, or hard money loans. These can provide flexibility, faster approvals, or access to deals traditional lenders wouldn't touch, but often come with higher interest rates and shorter repayment periods. Another useful tool for both homeowners and investors is refinancing. Refinancing replaces your current mortgage with a new one, typically to lower your interest rate, reduce your monthly payment, or change the loan term. Some people also refinance to access equity in their home, a process known as cash-out refinancing. While refinancing can save money or free up cash, it's not free. It often comes with closing costs, and if the new loan extends your term, you could pay more interest over time despite lower monthly payments. It's essential to calculate the break-even point to ensure refinancing makes financial sense. Lastly, let's discuss emerging alternatives in real estate financing. Technology is changing the landscape. Crowdfunding platforms now allow people to invest in real estate projects with relatively small amounts of money. Peer-to-peer lending platforms offer new ways for borrowers to access capital without going through traditional banks. While still in the early stages, these innovations are democratizing real estate finance and could reshape how property is bought and sold in the future. In conclusion, real estate financing is more than just a way to buy property. It's a complex financial decision that affects your cash flow, credit, taxes, risk exposure, and long-term wealth. Whether you're a first-time homebuyer or a seasoned investor, understanding how financing works and its true financial impact can help you make smarter decisions. Take time to learn your options, compare lenders, understand the costs beyond the interest rate, and most importantly, borrow responsibly. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and turn on notifications for more deep dives into personal finance, investing, and smart money strategies.